Imagine looking at a financial institution that's basically bracing for global economic turbulence, right? By
Mhm.
locking away over $164 billion in liquid reserves.
Yeah, just an absolute mountain of cash.
Exactly. They're building this total fortress, yet in the exact same quarter, they turn around and, casually drop $2.5 billion simply buying up their own stock.
It's a bizarre dynamic. It's this high wire balancing act.
Right. We're looking at a company that's telling regulators, hey, we're preparing for the worst, while simultaneously telling Wall Street, we have literally never been more confident in our growth.
That tension, between extreme defense and aggressive offense, that's really the defining characteristic of modern high finance.
Yeah.
Because when you dig into how these giants actually allocate their capital, you can bypass all the usual economic guesswork to see
Ah.
exactly how they're placing their bets.
And that is exactly what we're decoding for you today. Welcome to the deep dive.
Glad to be here.
So we're looking at the financial health of the American consumer and really the banking sector as a whole through the lens of Capital One's first quarter 2026 earnings results. These just dropped on April 25th, 2026.
Fresh off the presses.
Right. And the mission here isn't just to, recite a 20-page corporate spreadsheet to you. We want to show you how a massive banking giant is fundamentally mutating its business model after a historic acquisition.
While also, navigating shifting interest rates and some incredibly complex consumer credit risks. Earnings reports like this are really the ultimate truth tellers about the broader economy.
Okay, let's unpack this because I want to start with the stark reality of their headline numbers, which kind of immediately reveal this massive transformation beneath the surface.
Yeah, the top line numbers always set the stage.
Right. So Capital One reported a Q1 2026 net income of $2.2 billion. That works out to $3.34 per diluted common share.
Which is, that's a formidable baseline right there.
It is.
For context on the top line, their total net revenue was $15.2 billion.
Okay.
Now, that's technically a 2% decrease from the fourth quarter of 2025. But, and this is crucial, the real story is hidden beneath that initial $3.34 per share figure.
Because right next to that reported number in the deck is their adjusted net income. And that jumps significantly to $4.42 per share.
Right.
You have a gap of over $1 per share there. And the explanation for that gap is entirely driven by their acquisition of Discover.
The elephant in the room.
Exactly. Richard D. Fairbank, their CEO, he said in the release, our results in the first quarter reflect solid top-line growth and strong credit performance.
But he immediately pivots, right?
Yeah, he immediately pivoted to note that the Discover integration is going well and building momentum. He basically has to highlight that because digesting Discover is costing them an absolute fortune up front.
Oh, yeah. What's fascinating here is how the accounting translates physical business transformation into raw numbers, because they list two massive, adjusting items for the quarter. First, you have $477 million in Discover amortization expenses.
Wow. Okay.
Which is essentially the accounting reality of writing down the premium they paid for Discover's intangible assets over time.
Just the cost of doing a deal that big.
Exactly. But second, and perhaps more operationally telling, you have $415 million in pure Discover integration expenses.
Taking nearly $1 billion in hits in a single quarter just to absorb a company is massive.
It's a huge undertaking.
I picture it kind of like buying a giant, slightly dated mansion. Like you own the deed, you have the house, but your entire first year is just spent paying for scaffolding, rewiring the whole place, and moving trucks before you can actually throw a party.
That's a great way to put it. Those integration expenses, that $415 million, that's the scaffolding and the electricians.
Right.
And the market focuses heavily on that adjusted $4.42 per share because investors want to know the run rate of the clean business. They want to see the house once the scaffolding is gone.
But absorbing Discover wasn't just about buying a new house, right? It was about inheriting millions of new tenants, which kind of forces us to look closely at the pulse of the American consumer. Like, are people actually paying their bills?
Yeah, the credit quality question is huge right now.
Because Capital One is currently sitting on a total allowance for credit losses of $23.6 billion.
It's a massive reserve.
And furthermore, in just this first quarter alone, they took a provision for credit losses of $4.1 billion, which that's the quarterly expense they set aside for expected bad loans.
Right, though that was actually down $74 million for the previous quarter.
Okay, sure, but they still had actual net charge-offs of $3.8 billion.
They did, yeah. They also added a $230 million allowance build, primarily directed toward their auto and commercial businesses.
So they're actively padding that total reserve. But I have to say, I look at a number like $23.6 billion sitting in a reserve specifically earmarked for people defaulting on their loans, and my instinct is the sky falling?
It sounds alarming, I know.
If a bank is actively writing off $3.8 billion of bad debt in a span of 90 days, how is that not a flashing red siren signaling an imminent consumer recession?
Well, if we connect this to the bigger picture, you start to see that consumer lending, especially at this scale, functions much more like a casino's house edge than a traditional pass-fail loan system.
Okay, what do you mean by that?
The bank doesn't expect every single player to pay back their debt, just like a casino doesn't expect to win every single hand of blackjack.
Oh, I see.
The $3.8 billion in charge-offs isn't a systemic failure, it's just the statistical probability playing out, is the cost of goods sold.
It's just baked into the math.
Exactly. They model their interest rates
Mhm.
specifically to absorb those exact losses and still generate billions in net profit.
So they're pricing the defaults into the product itself.
Yeah.
Because looking at the specific credit card segment, their net charge-off rate is 5.05%.
Right.
And the 30-plus day performing delinquency rate, so consumers who are behind on payments but haven't totally defaulted yet, that sits at 3.70% for domestic cards.
And they expect those exact margins of failure. They demand statistical predictability.
Yeah.
The danger to the bank isn't the 5% of people who default. The real danger is a macroeconomic shock that suddenly pushes that number to, say, 10 or 15% overnight.
Right, something totally outside the model.
Exactly. And that is why they explicitly monitor forward-looking risks so aggressively.
Which explains the really extensive list of macroeconomic variables included in their forward-looking statement.
Oh, they list everything.
They really do. They are actively monitoring inflation, deflation, potential recessions, and trade policy actions like tariffs. But they also go out of their way to explicitly factor in geopolitical instability.
Which is critical for risk modeling.
Yeah, they cite the ongoing war in Ukraine, the conflict in the Middle East, and the political instability in Venezuela. And, for anyone listening, it's crucial to understand the bank isn't taking a political stance here.
Right. No moral judgments.
None at all. They're literally just plugging these global events into a localized mathematical model.
To a bank's risk modeling software, a conflict in the Middle East is fundamentally an energy supply variable.
Wow.
Political instability in Venezuela, that's an oil pricing dynamic. A disruption in a foreign shipping lane translates directly into domestic inflation, which hits the American consumer's wallet, which then alters the probability that a cardholder in Ohio will miss their minimum payment.
That is wild to think about. That $23.6 billion allowance is basically their mathematical shock absorber against the butterfly effect of global geopolitics.
Exactly. It's a highly calibrated shock absorber.
But the engine pushing the whole vehicle forward is what seems to have completely changed overnight.
Oh, completely.
Here's where it gets really interesting. When you look at the year-over-year differences across their specific business segments, you are basically looking at a radically different enterprise.
Because of Discover.
Right. The credit card segment's period-end loans held for investment hit $270.5 billion. That is a 72% increase year-over-year. Purchase volume is up 40%. Revenue in the credit card segment is up 59%.
The Discover integration is no longer an abstract idea. It is
Sure.
fully baked into those year-over-year comps now.
It's real.
The scale is just massive.
Hmm.
But a lending portfolio of that size requires a correspondingly massive funding source. To lend $270 billion, you must acquire the capital to support it.
And that capital is coming directly from their consumer banking segment.
Yeah.
Ending deposits are up 35% year-over-year, hitting $438 billion.
Wow.
They also generated $11.1 billion in auto loan originations, which is up 21%. So they are holding $438 billion of consumer cash.
That's the tool.
Right. And the presentation notes that their average deposit interest rate paid is 2.84%. That's the actual yield an everyday consumer earns keeping their money parked at Capital One.
Right.
But their net interest margin, the NIM, is sitting at a massive 7.87%.
That spread is the core engine of their profitability. Because, most traditional banks are currently facing severe margin compression because interest rates have been volatile. So traditional banks are forced to pay high yields to keep their depositors from just taking their money elsewhere. But their assets are often locked into older, lower-yielding fixed products.
Like 30-year mortgages.
Exactly, mortgages or commercial real estate.
Yeah.
So they get squeezed.
Squeezed in the middle. But Capital One is largely insulated from that specific mismatch because credit card interest rates are inherently variable, right?
And significantly higher.
Right. They pay depositors that 2.84% and then lend it out on the card side at 18, 20, or even 25%.
It's a huge gap. A net interest margin of 7.87% across an entire portfolio of this size indicates incredible pricing power.
It does.
And they've now layered an entirely new dimension of revenue on top of that spread. Because by acquiring Discover, they didn't just acquire loans, they acquired the network.
Ah, yes, the network.
Capital One now reports on its global payment network, which showed a network volume of $174.3 billion for the quarter.
This completely changes their identity. Every time someone swipes a card on that network, regardless of whether Capital One even issued the loan, the network takes a fraction of a cent or a small percentage of the transaction.
They're collecting the tolls on the highway.
They really are. They have vertically integrated. They are now functioning as the bank that holds the deposits, the issuer that funds the credit loan, and the network that processes the merchant transaction.
It's a closed loop.
Which brings us back to that high wire balancing act we talked about at the very beginning. They have experienced historic growth, but they are also managing unprecedented risk at scale.
Right.
So how do they ensure they don't tip over? We have to look at the fortress they've built to satisfy the regulators. Capital One reported total liquidity reserves of $164.8 billion.
And within that reserve, $76.5 billion is held in pure cash and cash equivalents.
Just sitting there.
Just sitting there. Regulators want to ensure that if a systemic shock occurs, the bank does not have to sell off its long-term assets at a massive loss just to cover immediate withdrawals.
And the ultimate metric for that is the liquidity coverage ratio, right?
Correct.
Capital One's average quarterly liquidity coverage ratio is 166%.
Which is exceptionally high.
Yeah, for a bit of context, a 100% ratio means the bank has exactly enough highly liquid assets to survive a severe 30-day stress scenario where depositors are actively pulling their money out in a panic.
A bank run.
Right. So having 166% LCR means they are holding 66% more liquid capital than the absolute doomsday scenario legally requires.
They are far, far exceeding the regulatory floor. Similarly, you look at their Common Equity Tier 1 capital ratio, or CET1, which sits at a very strong 14.4%.
Let's distinguish that from the liquidity ratio for a second. If liquidity is the cash they have on hand to satisfy a sudden panic of withdrawals, CET1 is more about their structural solvency, right?
Exactly.
It's the core equity, like common stock and retained earnings, that the bank holds. It basically acts as the structural foundation of the house.
Right. If their loans suddenly go bad and they take massive losses, the CET1 equity absorbs that blow so the depositor's money remains safe.
That makes sense.
Yeah, that is the perfect distinction. Liquidity is the fire extinguisher for an immediate cash crunch. CET1 is the structural fireproofing built right into the walls to prevent the house from collapsing if the loan portfolio catches fire.
I like that.
And regulators look at a 14.4% CET1, and they see a profoundly well-capitalized institution, fully capable of absorbing significant macroeconomic damage.
But then we hit the contradiction. They spend all this energy proving to regulators they are an impenetrable fortress hoarding cash.
Right.
But during this very same quarter, they executed a massive stock buyback, repurchasing 12.1 million common shares for $2.5 billion. So what does this all mean? Like, why burn $2.5 billion of capital if the goal is to be a fortress?
This raises an important question about how capital is truly utilized at the highest corporate levels.
Okay.
A CEO is constantly evaluating the cost of capital. When they buy back stock, they're reducing the total number of outstanding shares, which instantly makes every remaining share more valuable.
It increases the earnings per share metric we discussed earlier.
Precisely.
It's kind of like personal finance, right? It's like having an emergency fund that covers 5 years of living expenses. That's your liquidity reserves, but still having enough spare cash to aggressively invest in your own business through stock buybacks.
Yeah, because the same slice of pie is suddenly being divided among fewer plates. But it also signals incredible internal confidence. You only buy your own stock if you truly believe the market is undervaluing your future earning potential.
They are flexing their financial muscle.
Exactly. They are telling Wall Street, we have so much excess capital, even after fortifying our balance sheet to regulatory extremes, that the absolute best return on investment we can find anywhere in the market is just buying our own company.
It is the ultimate display of operational leverage.
It really is. They are absorbing the billion-dollar integration costs of Discover, padding their credit loss reserves against global instability, yielding a massive net interest margin, and still generating enough excess free cash flow to buy back their own equity.
It's just a phenomenal quarter on all fronts. So for you listening to this right now, when we synthesize Capital One's first quarter of 2026, we see a company that has successfully swallowed a whale.
A very expensive way.
A very expensive whale. They are dealing with the friction and the scaffolding costs, but the underlying engine has effectively doubled. They are managing $270.5 billion in credit card loans, funded by $438 billion in deposits.
And protected by an incredibly thick fortress of liquidity and equity.
Right.
They are executing a transformation of scale that is, honestly, rarely seen in modern banking. They are proving that their forward-looking risk models can sustain the natural volatility of consumer credit, even amid unpredictable global supply chain and energy disruptions.
But I want to leave you with one final thought to explore on your own. It goes back to that $174.3 billion in global payment network volume. Because for decades, the global plumbing of consumer finance has essentially a duopoly controlled by Visa and MasterCard. If you used a Capital One card in the past, Capital One assumed the credit risk, but Visa or MasterCard collected a toll for facilitating the swipe. By buying Discover, Capital One fundamentally altered that dynamic.
They ceased being a tenant and became a landlord.
Exactly. They now own their own plumbing. This vertically integrated model where the bank that issues your loan also processes your merchant transaction is a massive consolidation of power.
Huge.
Think about how this might shift the balance of power in your own wallet. If Capital One no longer has to pay Visa or MasterCard a cut of billions of transactions, the margin they save is immense.
Oh, absolutely.
Could they use that margin to offer you unprecedented reward structures? Could they leverage it to lower merchant fees and basically undercut their competitors?
That's the billion-dollar question.
And perhaps most importantly, could this closed-loop ecosystem force the legacy credit card giants to fundamentally change how they do business just to keep up?
It's a structural pivot. The ripple effects won't just impact their quarterly earnings. They really have the potential to reshape the economics of every checkout counter in the country.
It really does change the entire game. Well, thank you for joining us on this deep dive.
My pleasure.
The best way to understand where the global economy is heading isn't through surface-level talking heads. It is by looking at the raw data of the institutions actually building the infrastructure and moving the money. We started today looking at a simple contradiction between safety and growth, and we found a company in the middle of a historic evolution. We'll see you next time.